Hey everybody, good morning to you. My name is Brent Moores. I'm sitting in for Mr. Kevin Horner, who's out traveling today, out to a workshop. Headed to a workshop today, but it's time for today's Trader Talks in today's market. I'm just glad you're here. A good way to start the day, I think. Check up on the markets. We'll look at various parts of the markets, and I'm here along with Mr. Scott Thompson, who's helping me out in the chat. So I appreciate Scott. And so between Scott and myself, we'll do our best to answer your questions. And also, you can follow me on X, formerly known as Twitter, at Brent Moores CS. I put out additional content, market-related content throughout the week here. And there we go. I want to, interesting day in the market, interesting day yesterday in the markets. We'll see how we follow up on that huge run yesterday. But the information today is for general informational purposes only. It's not an individual recommendation of any security strategy or chart type. And options do carry a high level of risk and are not suitable for all investors. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. The paper money software application is for educational purposes only. Schwab does not recommend the use of technical analysis as a sole means of investment research. Past performance is no guarantee of future results. All investing involves risk, including risk of loss. And there we go. So what are we going to do? We're going to talk about the general trend of major markets. We'll look at we'll look at sectors, see how different sectors are performing, and we'll look at charts, look at different time frames. And there we go. Let's head on over to the Thinkorswim platform. Here's the SPX. How are we starting off today? Well, this is, you can see yesterday's run. This was a huge run. In fact, let's do this. Let's go to, let's head on over to a 5-day, 5-minute chart. And let's start off with yesterday. Yesterday was starting off as an okay day, but once the announcement of the 90-day pause on tariffs came into effect, it just took off, and a massive run up. Probably not super surprising after you get a huge day up that we're opening down a little bit, but volatility is high, so it would not surprise me to see what to see big moves up or big moves down today. Let's do this. Let's go out to a little bit longer term view and just look at some potential levels here. This is where we are, the lows we've hit of late. Okay, so this would probably be kind of a key level right down here. Our low that we hit, I don't know, last week. Okay, right there. That would be, but to get there, we're actually going to have to break down pretty significantly at this point. Significant highs, well, we already broke above, fortunately, we broke above that gap level on this one. We're opening up below it today, so it'll be interesting to see throughout the day whether we can hit that level, break above that level would be, I think, a pretty significant pretty significant break. Of course, we are a long ways from anything considered to be an uptrend right now. We had lower highs, okay, kind of going down. We've had lower lows. What we'd like to establish is another high above this most recent high in order to get back to, in order to start the discussion of an uptrend. But right now the market seems to be pretty volatile on that front. Now let me go back to the 1-day, 1-minute chart here on this. And what I want to do is I want to throw on some pivot points here on this chart to look at some potential intraday levels that we're looking at. So here we go. This is a 1-day, 1-minute chart. This is where we're starting out. Here's our initial pivot point. If we're looking at intraday support levels and resistance levels, if we can maintain this level, I'm going to zoom in just a little bit more, we only have a few minutes of trading at this point. This is a potential support level. If we break down, this is another potential support level. Once we break potential support levels, they then become a potential resistance level. So we'll have to see on the intraday level what we've got, but we have seen most definitely a weakening in the market in terms of this. Let's look at, let me go to this dollar sign SPX A50R is the symbol. You guys can type that in yours if you like. This is the percentage of companies in the S&P 500 above their 50-day moving average. Percentage of companies in the S&P 500 above their 50-day moving average. We're at 12, about 13% right now. That's obviously pretty low. So as the market goes, so goes the individual stocks for the most part, only 12%. And you can see that is like, I don't know how far back. Let me go see if I can go to let's go to the 3-year chart on this. You can see how low we are compared to where we've been here on this right now. Now let's do this. Let's head on over and let's look at the SPX EW. This is equal weight S&P 500. In other words, this is taking all 500 stocks in the S&P 500 and giving them equal weight. And instead of just weighing those big companies down more as a bigger percentage of the index. So instead of Apple and Microsoft and Google or Alphabet having a disproportionate weight, this is giving everything equal weight here. And you can see what we've looked like here. And, oh, that's a 3-year. Let me go back to my 1 year. Here's my 1 year on this. And you can see fairly similar in this regard. This high, again, is probably a pretty significant level for us to break and potentially hold on that one. Okay, so that's the S&P 500. Now, what is we're down today on this. Again, looks fairly similar. Where's my resistance going to be? Probably the 20-day moving average, which is the red line, which is right there, is a potential resistance level on this. Obviously, today's candle's pretty small. We actually did have some good news this morning come out. We had CPI numbers come out, and the CPI numbers were actually pretty good. Year to year, CPI came out as a 2.4% inflation rate, 2.4%, which actually is a beat, better than expected. 2.8% for core inflation annual. That the core inflation excludes energy and food. And again, those were beats. Unemployment came out as well, but that kind of fell right in line. So normally I would expect with those CPI numbers that we may have had more of a positive reaction. But I think in the context of this kind of huge day yesterday, I think it is that's probably why we're not reacting more positively to the S&P 500 here. But you can see, I mean, you may look at this and go, well, this is and this is the NASDAQ here. You can see, well, that's a green candle. Well, we're down from our high there, and so similar results on all the major indexes. Here's the Russell 2000. Again, small caps, huge rally yesterday. Again, where's our next potential resistance level? This is probably, yesterday's high is probably where I consider that to be a key break here on this here. And Beth made an important point in the chat. Beth said the CPI is backward looking. Absolutely, the CPI is backward looking. So we'll have to wait and see. One of the concerns in economic concerns right now is what is the future course of inflation? What's the future course of prices, especially in the in light of tariffs? So we'll have to see. The announcement for those of you who were not here, yet weren't paying attention yesterday, the administration announced there's a 90-day pause in tariffs across the board, with the exception of being lowered to a 10% rate, effective immediately, with the exception of China. China, 125% tariff. I think I got that number right there on that. So that's what's affecting the market right now. So let's take a look at volatility on the market and the VIX there. So Carol said probably a lot of profit taking. Yeah, probably a fair amount of profit taking. People who maybe felt in fact, does this describe you? You have kind of felt in a bind after the market pullback that I don't want to sell when it gets super low. Right now, I think that's one reason why we may have had selling off just a little bit today. So here's the VIX. Now, what the VIX measures, okay, a lot of you are familiar with the VIX, have heard of the VIX. The VIX gives you an annualized view of expected market volatility. So for the S&P 500. So the market up or down, it's just an estimate. That's all it is. It's just an estimate. Market up or down from a year from now, 36%. That's a big move. That's a huge move right now on the VIX. VIX is, and of course, if we zoom back out on the VIX, you can go out and see that, you can see historic levels. We're probably down in the teens. Okay. Right now, it's quite high, around 36%. That's a big drop from yesterday. So that's an annualized look at it. And the way it does that, it just measures implied volatilities of S&P 500 at the money options. Well, near the money options, I should say. Now, that's an annualized look. On X later today, I'm going to be posting a video talking about a daily look at volatility, what the VIX can tell us about daily volatility. So if you check that out on my X feed later today, you'll see that at Brent Moore's CS. I just put the video together. I need to get it posted though. I haven't posted it yet, so we'll hit that up later. Now, so obviously a drop, but still very elevated VIX levels. We'll look at individual stocks, individual sectors later. But something that I think we need to point out is, let's look at interest rates here, because that obviously has a big effect in the market. Here's the TNX. In general, this is the 10-year yield. Now you may be saying 42, it's not 42%. Move the decimal point over one spot. So 4.29, or about 4.3% is where the 10-year yield currently is. Generally a lowering. Now, why do we pick the 10-year? The 10-year is kind of generally deemed to be a kind of a key economic, a key indicator of interest rates across the board. It's different than the short-term rates. But if you look at like mortgage rates tend to be associated with the direction of the TNX. Not that you can get a mortgage for 4.3%, but they tend to be correlated with one another. So there's that. But keep in mind, we can talk about short-term rates and longer-term rates. The general trend right now has been going down, although we've seen a bump up in those rates. If you want to look at an idea, at least, and it's certainly no given, an idea at least of shorter-term rates, this is a Fed fund rates tool. This is called the CME Fed Watch tool. And the way you read this is you can look right up here, and if you want to see it, you can go to CME Fed Watch. You can just Google that and you'll find the page. This is the current rate right here, okay? This is where we currently are. This is looking at the next meeting here. And I got to get rid of this in order to scroll here. May 7th, so about just under a month here. And basically what it's saying is current rates most likely to hold on May 7th. But I think what's more interesting is go out to the end of the year. Here's December, and these are, of course, just estimates. How does it come up with the estimates? It uses Fed fund futures. So this is what market participants are kind of anticipating for Fed fund rates, but it is certainly no guarantee. This is where it gets a little bit more interesting to the end of the year, because let's look at, again, we're right here right now, and basically the markets are saying there's just a minuscule chance that the Fed funds rate is where it's at right now. Now, one possible reason for this is of the expectation of lowering of rates is that people are a little concerned about either recession or at least economic softening. And the Fed is more likely to lower rates in the light of that than if they anticipate a super strong economy. Additionally, Fed fund rates tend to be lowered in light of if there's more concerns about inflation. Well, the inflation numbers came in a little bit lighter today, which is nice, but these numbers are still showing a significant drop. Again, probably more in anticipation of kind of normalizing rates and also maybe giving the economy a little bit of a boost. But we'd consider this kind of one rate cut, this kind of two rate cuts, this three rate cuts, although they don't all have to, you can do a double cut in any one session here. But you can see where the biggest kind of the expectation right now is about 4 rate cuts between now and the end of the year here. So that's pretty significant. Now, before you get too excited about it, just realize that does, if you're want to refinance your house or something like that, or buy a house, the long-term rate doesn't necessarily match the short-term rate. In fact, if you look at this right here represented the day before they made a big cut in the short-term rate, and you can see the longer-term rate went up from there. So they're not necessarily correlated, but the general direction of late has been lowering, except for that little bump that we've had there. Okay, so that's the Fed Watch tool. That's interest rates. Obviously, there's other parts of the market other than that. We'll get to sectors in a minute, but let me just talk about a couple other, I think, significant parts of the market that attract people's attention. By the way, on my graph, on all these graphs, I should have mentioned this before, I have a 20-day moving average and I have a 50-day moving average, okay? This is gold. These are gold futures. We're not using this as a tradable instrument or anything like that here. All we're talking about is what's the price of gold doing in terms of the economy here, and in terms of an investment, a potential alternative investment that some people use. We're not using it here for that purpose today, but a lot of times people will invest in gold when they're more concerned about other parts of the market. And you can see there's been concerns for quite a while. If you were to consider gold to be a flight to safety instrument, the returns on gold have been pretty significant. In fact, what you can do is let me do this. I'm going to make this a prices percentage graph. And here's a 9-month graph. Gold's up 32% over the past 9 months. How many other asset classes do you know that are up 32% over the last 9 months? We can change that time frame too. If I go to a 3-year chart, up 59% over the last 3 years. So even over the last, say, 3 months, up 15% over the last 3 months. So you can see why that holds some attraction. Of course, with any instrument, there becomes a concern at some point of valuation on these, and has it been bought up enough? We had a pretty significant drop this past week, although it has recovered the last couple days on there. So that is always something that people will look at. And if you're interested in things like gold ETFs, I can't talk about them today, but just realize tomorrow morning Trader Talks tomorrow morning, we talk about ETFs, okay? Trader Talks tomorrow morning, we talk about ETFs. We also have an ETF class on Mondays at 4 o'clock Eastern Time you can check out called Trading ETFs if you're looking for that. Let's look at another thing that is, people find of interest in the economy, and that is, again, it's a future, but we're not going to trade it. We're just looking at this as an indication for oil prices. This is West Texas Intermediate crude oil prices. So you can see the drop we've had and dropping more. Again, there are issues when you're talking about oil prices. Remember, there's two sides of the equation. There's the supply side and there's the demand side. We are not lacking on the supply side right now, it seems. And the demand side is it's forward-looking. Who was it earlier? I think Carol maybe said, hey, no, actually it was Beth, I think, said CPI is backward-looking. Well, oil prices tend to be more forward-looking when we're talking about demand. And if the expectation is, for example, a U.S.-China trade war, that would tend to lower demand and is going to tend to knock down oil prices here. So that may be good for you and me at the pump, but it also can be kind of an economic signal. Oil prices do not necessarily correspond to what you price, what your gas prices are, though. If you want to look at that, we can go to the RB, the RBOB futures. This is gasoline futures. You can see it was strong, a little bit different there. It has dropped down. We're not quite there, this doesn't necessarily mean you're going to pay less today than you did yesterday at the pump, but this tends to lead to lower gas prices across the board there. Okay, so there is that. Now, I want to take a look at sectors as well. So let's do that. Let me just move over and let me go right here. And I have a couple columns here. I have a percentage change column for the day. Okay. Here's a percentage column for the day for each of my sectors. Now, this sector watch list is available to everybody out here. It's a public watch list, as are these columns right here. So the sector watch list, you can go down to public, and it's just S&P 500 sector indices there. Okay. The S&P 500 sectors and industries breaks it down further into specific industry groups. But right now we're looking at sector indices. These columns, if you go and you can click on the little gear, click on customize, there's a percent change, which is just today's, okay? And then there's a percent change since, there's a percent change since, and you can adjust the time frame on there. Okay, to see that, at least on mine, typically you have to scroll over a little bit, and I can say, well, let me go and let's look at the last month here. Okay, so I'm going to do that. Click on OK, and now if I look at this is a percent change 1 month. And you can see every sector over the past month is down, some more so than others. Okay. Question in the chat from Ranjit. Why doesn't gas correspond with oil? Oil is just the raw product. Remember, gasoline needs to go through transportation. It needs to go through the refining process. So that is different beasts there. There is some correlation there between the two, no doubt, but it's not as direct as it would, maybe you'd think at first glance there. But there you go. Okay. So what's been the worst performing sector over the last month? Energy. Actually, wait, do I have that right? Let me just sort this. Energy, everything's been down. Energy is the worst performing sector over the last month. And today, it's the worst performing sector. So we've just been talking about some energy and how it's dropped. Well, oil isn't 100% correlated. You know, it doesn't tell you exactly what energy is doing because the energy sector is more than just oil prices. Keep in mind, there's like natural gas prices out there we could look at. There's other parts. There's clean energy type things. There's other parts of the energy sector. There's other companies that aren't involved in oil per se that are in this sector. But you can see it's still had really a terrible performance here. Part of that is probably demand based and again, forward looking on there. In terms of this, here was our previous lows on this. And we tested those not that long or yesterday. We tested those. Again, looking for that break above there. But we'll have to see if this continues as a trend or if we can break out above or if we consolidate here between those in terms of the energy sector. So there's that. What other sectors have not been for? Healthcare has not been doing well. I mean, everything looks pretty similar. In fact, we kind of had this head and shoulders pattern on healthcare going up here. See that? It's kind of a classic head and shoulders. When you do that, usually what you do is you take that neckline there and you go, if it breaks below there, that's usually a bad sign. Well, sure enough, it came about. Whenever we do price patterns, by the way, there's no guarantee, especially when we do like a target or something like that, there's no guarantee it's going to do that. Sometimes it works out and sometimes it doesn't. But generally, this head and shoulders pattern is considered to be more of a bearish pattern and with a potential for a big downside. Well, it certainly happened in this case. We've seen some recovery, but again, there's our lows. There's our most recent high. That's what we'd like to see recovering from there on that one there. Okay. So question from Probability Trader. Why are we seeing strength in consumer staples? Well, let's get to staples here. Why is staples the best performing sector? Well, let me tell you this. Generally, so let me go today's change. Consumer staples, there's today's change. And overall for the month, has it been the top performing sector? It has been the top performing sector for the month. Here's staples. You can see, yes, it's dropped, but it's actually recovered pretty significantly. A lot of those others, we've struggled with those lows that we hit before, breaking back above those. We've broken back above those. You can classify these sectors as either kind of defensive sectors. Okay? And when I say a defensive sector, we're not talking defense industry like General Dynamics or Lockheed Martin. Defense sectors are those sectors that tend to outperform when there's worse economic conditions and the market's not doing as well. Consumer staples is kind of the consummate defensive sectors. It doesn't mean it's going to go up. This one, it's been down 2% this month, but compared to a lot of these, it's doing a lot better. That's what when people are worried about the economy, that's where staples tend to do better. If you think about staples are things you buy every day that are still likely to be on your shopping list, so to speak, even if the market even if you're feeling pinched in the wallet. People still buy soap, basic food items. They still pay their utility bills, right? Energy, gas, electricity. Real estate tends to be a little less correlated. And you can see that after we get out of those, we're not doing as well here as we go down. And energy tends to be a little less correlated as well, but it's getting hit for other reasons as well, too, there. And as Carol said, folks still need to buy toilet paper there. So these are kind of more defensive type sectors versus what we'd call more cyclical type sectors down there. Okay, so let's move on. So there you go on that. That's your sector look. What have been the most hit? Well, over the last month, let me sort this again. Energy, we already mentioned. Materials, healthcare, real estate, information technology. And of course, you can see that as you look at things. Well, let me go to that IT sector. Tends to be more volatile than a lot of sectors there. Beth made a good comment in the chat. Beth said, "Do you find the action in Walmart interesting, even though they sell a lot of products made in China?" Yeah, that is something that's going to certainly affect these companies. Yeah, I don't know. I mean, ultimately, I think a lot of it goes down to they certainly do sell a lot from China, no doubt, as do a lot of other companies. But people still are going to buy basic foodstuffs, and some of people, if the costs come about, the question is, can they source to other places? Is that a possibility? How much of that is going to be borne? How much of the increased cost is going to be borne by Walmart versus by the consumer? I saw the CEO of Amazon stated he felt the costs were ultimately going to be paid by the consumer and not by the company themselves. So it is an interesting point that Beth brought up, though, there. So that's kind of a big thing. Now, of course, we can get caught up in the whole market right now. We can get caught up in economic news, although really right now, stuff like that inflation number and the unemployment number have actually kind of taken a back burner, so to speak, to the just news coming out of the White House, frankly, on that. And I want to thank all of you for keeping the chat market-based and not political. This chat is for everybody, and and so we appreciate you respecting other people in that regard. But we do talk about what's coming out of the White House because it certainly does impact the markets there. But another thing that can certainly affect the markets is earnings. And earnings season is right upon us, folks. Let's take a look. Let me go to Market Watch. Here's today's heat map, by the way. You can see those companies there, it's interesting, by the way. I'm going to get to earnings calendar in just one sec here. But it's interesting when you look at the heat map. This is for the S&P 500 right now. Here's, it breaks it down by sectors. So you can see here's IT, pretty much all red, right? Maybe there's something that's up a penny or two. I don't know. You can see financials. You're starting to see down here, you can see a few green stocks. But you can see where staples is coming in. That's actually kind of this island of green. Well, utilities is actually doing okay too. And healthcare. So you can kind of see what I was showing on the other graph using this as well. By not just looking at the overall heat map, by the way, as kind of breaking it down on terms of sectors. All right. So there we go. But I wanted to take a look at the earnings calendar because this is big news. So we're going to go to calendar, and I have S&P 100. If you don't have anything in there, which is absolutely fine, and you pull up the earnings calendar. So we pull up calendar, and then let's check earnings. If you have everything, by the way, it's probably going to be more confusing. So what we're going to do is we're going to uncheck. We're going to check earnings. One challenge is you get a bazillion companies there, don't you? You get a ton of companies on this. I have this on a list, but you can do it on whatever mode you want to look at. And you can look at your daily mode there. I'm just going to look at a list. To me, I like the list, but that's that's your call on that. But what I would suggest is you narrow it down. Go up to the gear right here and go up to public and go to S&P 500 if you want. For my purposes, I'm actually going to go to S&P 100 here, just to narrow it down a little bit more. Today is April 10th, okay? And so let's look and see what we have coming up here. Tomorrow, okay? We have BlackRock, Bank of New York Mellon. We've got JP Morgan, Morgan Stanley, Wells Fargo. Do you see, can you think of anything these guys all have in common? These are all financial companies. Now, I've narrowed it down to the S&P 100, so there's other companies releasing out there, but the biggest companies releasing earnings tomorrow are these financials. This is the traditional kickoff to earnings season. Earnings season is now upon us, starting tomorrow. Coming out Monday, Goldman Sachs, Bank of America, Tuesday, Citigroup, Wednesday. Then we start to get to some non-financials there on that S&P 100. Johnson & Johnson, Abbott, USB, American Express, United Health Group, Netflix. Those are all next week. So we're getting some big names coming up. Now, it's going to be a couple weeks. We're going to start to get some others. And there you go. Okay. So, and you can scroll down. If you want to find a specific stock, you go, when's Apple earnings? Well, there's two ways. You can go to the calendar and go Apple, type in the symbol, Apple, May 1st. Another way, by the way, is if you go to the Analyze tab, go to hold on, let me get rid of my left column here. Go to earnings, and you put in the symbol, and you can see, oh, Walmart, earnings on May 15th. That's always an easy way there, okay? All right. So that's, that's, I think, something that is important, okay, to be aware of. We're going to start to encounter that as you're doing trades. If you're doing trades, if you're paper trading or something like that, that may be a consideration for you as to whether you always have to ask yourself, do I want to hold over earnings? I don't know. Maybe you're looking at Walmart here. We've been talking about Walmart, and you see, well, look, I think Walmart's going to be strong, if that's your thought. Okay, I'm not saying it's going up. We've have maybe some support here. We have some strong momentum right now. I'm going to go back to Walmart in just a sec, but let me just do SPX right now. SPX is down right now, and we're getting a little weaker. We're near the day's lows at this point. What's Walmart doing? Walmart's actually near today's highs. Maybe you're going to do a trade here on Walmart. And so maybe you want to ride that momentum. Well, let's do a paper trade on Walmart. How about? Okay, let's do a paper trade on Walmart. Now, again, I'm concerned about earnings. Are we going to encounter earnings? Well, I'm going to look for a shorter term trade. We already looked and saw that earnings aren't till May 15th. So we're over a month out on earnings on Walmart. Okay, so I'm going to do a trade, and I want to just kind of demonstrate here a trade with a trailing stop loss. And the reason is this is going up, but we've seen a lot of volatility here. And what I want to do is, if this goes up, I want to take advantage of the move up, but I also want to not have to constantly move my stop up manually. So what I'm going to do is I'm going to put a stop loss that is going to automatically move up as the highs of the stock go up. We're right here right now on the stock. I'm going to put a trail stop that's just a little bit below today's low, okay? So if I go to today's low on this, let's just look. Today's low is 88, I'm just jotting it down, 57, okay? I'm going to right click on this chart. I'm going to go buy custom with a stop. And this is just a sample trade. Of course, you can adjust your quantity to what you deem to be an appropriate amount for you. I'm going to do 100 shares on this stock right now, but you need to choose that for yourself. If I want to do a trail stop on this, what I can do is I can just say, well, I'm just going to buy this at the market, but on the stop, I'm going to make this good till canceled. And instead of stop, I'm going to click on stop and I'm going to put on a trail stop. Okay? Now, the stock right now is at $90.82. 90.82 minus 88.57. We're starting this out at today's low. It's a $2.25 trail stop. I'm going to make it a little bit bigger just because I want to give it a little wiggle room below today's low. If we retested today's low to the penny, I don't want that to stop out on me. So I'm going to make this a $3 trail stop on this trade. Okay, instead of two and a quarter, I'm going to make it $3. The default right here is plus or minus a dollar amount, which is absolutely fine. If you want to make this a percentage amount, you can do that as well. Just click on this. A couple times you go to the percentage. You can say, well, I want this to be minus 1%, or that would be a very tight trail stop, by the way. Okay, so I'm going to do this. I'm going to put in minus, I just put $3. Okay, and good till canceled. I'm going to click on confirm and send. Okay. And make sure you read this before you do this. And I'm going to click on send. Okay. Now, we've just entered this trade. What does this trail stop mean? What it means is this. It means that our current price is right here. Our current stop is right here. Okay. If this stock just goes straight down, we would stop out right here. We're risking $3 a share, 100 shares. We're risking $300 overall on that. That's our total risk. Now, there's no now, when I say risk, that does not imply that that is a guarantee. If Walmart were to come out with bad news and gap down to $80, we'd sell out probably around $80. That'd be losing about $10 in that scenario. $10 a share, 100 shares, that'd be $1,000. But we're going to assume, for our purposes here, that's going to be our risk. If the stock goes up, then let's say the stock goes up throughout the day and we end up $1 higher. Okay, where's my trail stop going to be? My trail stop will then move up $1 higher. It's going to trail every new high price Walmart attains. This trail stop will move up. Now, if Walmart goes down, does the trail stop move down below it? No, it doesn't, or else, of course, it would never get filled. You'd never hit your trail stop. So as the stock goes up, this trails above it. My one caveat on this is this. Traders tend to underestimate how quickly trail stops get hit based on just intraday moves. So if you look at, say, for example, the average true range, I don't think I have that as a quick link. I don't. If you look at the average true range on Walmart, okay, it's just above $3. Okay, so truly this is a momentum type play. When I say momentum play, I mean as long as it's going to run up, we're doing good. We're going to continue with this, but once it starts to turn around, we're going to get out pretty quickly here on this. Okay, so there we go. You can use that as an aid, that average true range, if you're interested in that. So that's an example trade. You know, that's all it is an example. That's it. Okay, folks, we are out of time today on this for this session. I'm glad you joined me today. Tomorrow we got ETFs. James Boyd and myself will be teaching ETFs for Trader Talks. Kevin will be back next week, of course, and we're glad to have Kevin back, of course, when he gets back. But we're also glad he's at that workshop. Please make sure you subscribe to that Trader Talks channel, everyone. That's how you can not miss the content that you want on YouTube. Trader Talks, Schwab channel. And, you know, we'll keep an eye on this the rest of the day. as we do so, here's where we now stand on this. Not a lot of range today, but we'll see. That changed a lot yesterday. Today's candle is, I can't say it's guaranteed to change, but given the volatility we've seen lately, that's pretty likely it will change. So I appreciate y'all. I appreciate Scott in the chat. And we will see you all hopefully tomorrow morning for our Trader Talks ETF session. Bye-bye, everybody.